Welcome back to Financial Minds Meet the Experts. I'm your host, Jaime Agostino. On this podcast, we're joined by financial industry experts to talk about topics, trends, and themes that credit union professionals need to know about. Today, I'm sitting down with two of my favorite financial minds, Vizo Financial's SVP Chief Treasury Officer, Tim Sustak, and SVP Chief Investment Officer, Scott Wood. Thank you both for joining me again. So I'm excited for this month. Last month, you predicted right. The Fed did hold. So I'm curious to see what you're thinking is going to happen next week. So Scott, everything I keep reading is telling me the Fed is going to raise rates next week by 25 basis points. What are your thoughts?
Yes. So we did get it right last time, which is maybe we should stop there and just run to the hills with our 100% batting average. So last time there was a good expectation the Fed was going to pause, and they in fact did pause for the first time in almost 15 months or so.
Yeah. Since
they started this rate hiking cycle that we're in right now. And if we remember back when they did their pause, they came out with some language. They were trying to emphasize the fact that they were skipping a meeting and not pausing. So we're using the pausing terminology, but the Fed themselves were actually, they pointed out a few different Fed speakers pointed out that it was actually, they preferred to use the term skip. In other words, to tell the market that we're skipping this meeting. We're not on a pause, meaning that, pause would indicate something more longer term, maybe a number of meetings. So they said, hey, we're skipping this meeting to let us know that there was a good chance that they could pick right back up at the next meeting after that, which comes up here in July 26th, so about a week and a half from now, almost 2 weeks, that they could pick up again at that meeting. So every indication since then has been that the Fed is very likely to increase rates by another 25 basis points at this meeting. The economic data that's been coming in has been relatively strong. I think we'll get more into that during our conversation today, but the economic data has been pretty strong. The Fed, obviously their main concern is still inflation. We'll talk about that again today also, but those things are still higher than the inflation has been higher than expected. The economy, jobs, and things like that have been relatively strong. We're still below, if you remember too, at the last meeting, they gave us their 4 times a year they do their economic projection update, and they told us in that basically that they anticipated another 50 basis points of hiking before they were done with this cycle. So they could certainly have room to go 25 at this meeting in a week and a half. And then, Powell has come out since then too and said they expect a more moderate pace. So the pause, another increase, and then maybe another pause, maybe an increase, at the August meeting, who knows, or September meeting afterwards. But they've set themselves up to resume tightening. So another 25 basis point increase. And when you look at Fed fund futures in the markets today, a little less than 2 weeks out, they're given about an 89% odds that the Fed is going to raise 25 basis points at the next meeting. If you go out to the September meeting, they're given 100% odds. So the markets aren't completely sold 100% yet on this next meeting, July 26th, but certainly they think there's another pause between another rate hike between the next 2 meetings. So very likely we'll see 25 in July.
All right. Well, that kind of leads me into my next question. So Tim, after June's meeting, it was kind of perceived that the Fed was penciling in 2 more rate hikes in 2023, which would push rates to a level we haven't seen since 2001. What are your thoughts, and how will this impact the credit union system?
Yeah, so as far as the rate side goes, I think, 2 more are certainly possible. I think not a given, and I'd kind of echo everything Scott just said about the Fed and the Fed talk and rates. I mean, certainly, the indication based on the latest projections from the Fed and, what Chair Powell said after the meeting, certainly, 2 more is definitely in play. But I'm kind of a believer that the Fed tells us the truth when they say they're data dependent. So, we'll see what happens. I agree with Scott. I think they're going to go in July. I think they want to, they're students of history, especially Chair Powell. He does not want to let up on inflation too soon. So I think I agree that 25 in July is likely to happen, and then we'll see after that. I think we'll see where the numbers go. We have a bit of a divided Fed, but yeah, I think that 25 will be there, and I think certainly 2 is in play, and we'll see what happens. Who knows? Anything's possible, right? Numbers go the wrong way. Maybe there's more than 2. You just don't know. I'm a big believer in the whole data dependent thing because there's too many moving parts to say for sure what's going to happen. Yeah. As far as the credit union industry goes, I think, to me, it's kind of more of the same of what we've been seeing, right? This just kind of twists the screw a little bit more. I mean, on the asset side of the balance sheet, loans are going to get a little more tougher to afford for some, obviously. So, loans still increasing, but at a bit of a slower rate. I think that's probably likely to continue. I think the loan mix continues to change a bit too. Auto loans, certainly, mortgages tending to slow a bit because of rates and affordability. We'll see more, as things get a little bit tougher. Savings continue to run out. We may see people move more to, cards, personal loans, things like that to make ends meet. So I think there'll be, continue to be, I should say, a little more shift in the loan mix. Just read a CUNA report that, kind of indicated those trends, right? I mean, it's, not only do rates make it tougher, but, housing prices where they're at, auto prices where they're at, the double whammy of price and rate, is making it more difficult to afford things. So it's, that lending is increasing at a slowing rate. So I think that certainly continues. I think the other thing is, asset values will continue to get stung a bit more. I mean, one of the big problems for credit unions, particularly those that kind of, got tired of waiting for the Fed to move, and Fed told everybody kind of low and slow on rates. And we know that's not really what happened. They placed their bets, and unfortunately those assets, have really taken it on the chin as far as value, and, not been able to sell those investments for liquidity when they've needed it. So, it all depends where you're at in the curve and kind of how the curve reacts a little bit farther out too. But I think, the increase in rates, can certainly, make asset values a little bit tougher, to bear as well. On the liability side, we just talked about the fact that, liquidity is strained a little more with lending and with asset values. The same thing on the liability side, right? There's gonna be that continued fight for deposits as rates continue to tick higher. We all know that it's easier than ever for depositors to move money wherever they want to move it in today's world. So, credit unions will have to certainly continue to raise deposit rates if they want to hold on to money. And, deposits will probably still continue to leak out a bit, and that'll serve to compress margin as well. I mean, what we gain with loan rates going up, we'll get squeezed a bit when we need to raise deposit rates. In addition, with the liquidity crunch, credit unions will, I think, continues, some of them anyway, will continue to have to use market sources of funding, which will also squeeze margins a little bit. I mean, I think we still have, I think everybody's feeling it a little bit, but I think we still have the haves and have-nots. Just talking to credit unions and watching our members and the way things are going, you have some that are really struggling liquidity-wise, and you have some that, starting to see it a little bit, but things are still okay. I think those things those trends, especially for the ones that are feeling it, will continue. And, there'll be an ebb and flow to this, right? I mean, not everything happens at once. As loans slow and deposit habits change based on rates and based on what's happening in the economy, CUs are continuing to adjust, right? There's a lot of credit unions that, have not been reinvesting funds, letting the funds that come due, either loans or securities, come back and kind of rebuild those liquidity coffers. So they try and right the ship a little bit. All those things will interplay, but I think it's just a bit more of the same thing we've been dealing with for the past, year or so.
All right. Well, Tim, also, back in June, Chairman Powell said we have a long way to go to bring inflation back to the Fed's 2% goal. Are we getting any closer?
Well, I think I think Scott alluded to it in his opening comments. I think, yeah, we've made some progress, but we're still a ways away. I think a couple of recent inflation reports we got here were encouraging. We'll say CPI up 3% from a year ago, lowest in about 2 years. We just got the PPI as well, up 0.1%, smallest gain in about 3 years. So I mean, that's all well and good. The core, which the Fed is more interested in, less food and energy, up 4.8% year over year. I mean, 4.8 still a ways away from the 2%, longer run goal that the Fed has. So we're certainly trending in the right direction, but one report does not a trend make. And, the Fed's not interested in a report. They're interested in seeing that type of report multiple times so they can be confident that that trend is continuing and that we're seeing real strides against inflation. Any given report can be wonky for any number of reasons. So we'll see if that trend continues. There are some things that may make that trend a little more difficult to continue. One is kind of the base effects, as they call them, right? Where, you look at the prior year, what you're comparing to, right? I mean, we're still comparing current data against some pretty strong inflation numbers. So that will wane a bit, and it'll be a bit tougher to get those decreases. Housing is still under a lot of pressure from a price standpoint, and housing plays a big role in inflation. We kind of had a lack of supply of housing going into this, with construction certainly slowing after the last financial crisis, and we had the supply constraint issues that came with the pandemic. And now with home prices the way they are, rates have risen, obviously, and it's harder for people to move out of home. So that kind of constrains supply as people decide, what, we're not going to move. So there's a lot of things that kind of are putting pressure on that housing market that aren't likely to go away anytime soon. So that'll still continue to push inflation. Like I say, it's certainly going in the right direction, but I think there's still work to be done. So
all right, so a little bit more time. So
a little more time, yeah.
All right. So Scott, the labor markets, are one of the key areas of focus. So are we seeing any signs of loosening here, and how are wage demands impacting our labor markets?
Yeah, so as Tim was talking about with inflation, we've seen some small or slight improvements. There's been positive moves in the direction that the Fed would like to go, right? We've seen some loosening of inflation. If you remember when this kind of was starting and they were on this path to lower inflation, one of the big things that they're looking at is labor, the unemployment rate and the labor force. And they anticipated a few months back that they would have to get to an unemployment rate of about 4.5% or so, 4.4 to 4.6%. So somewhere in the mid 4% unemployment rate. And the thinking would be is if they got to that level, it would mean that there were enough people impacted by losing jobs that would have a material impact on purchasing power and purchasing. And it would kind of cut back down inflation, get it to that 2% level Tim talked about that they target and want to get back down to. So the bad news is we're still way off from that unemployment rate, right? The last reading was 3.6% here for June that we got early in this month. We got that reading. So the bad news, I guess, is from the Fed's perspective is that the labor force, the labor indicators have all remained relatively strong. So the report that came out for June employment was a little weaker than expected, and it's really from the standpoint of the number of jobs that were created. The markets were looking for, closer to 300,000 new jobs. They had an ADP report that came out the day before that was pretty strong. They anticipate a pretty strong report here. They had a little over 200,000 jobs created in June, which is still a positive trend. The average over the last few months is, I think, the mid 240s, so that's good from a labor point perspective. But the issue here is a little bit weaker than expected, and then the prior 2 months were revised lower by over 100,000 jobs. So the revision to the prior 2 months and then the little bit weaker print for June was not positive for labor, but again, positive for what the Fed is looking for. But the unemployment rate actually went down from 3.7% to 3.6%. It really was just, decimal places lower, but the way they look at the number is showing a full, 0.1% lower there. So based on what the Fed's told us before, there's still work to be done. I think the Fed would be elated if they get inflation down to 2% target and then still maintain this strong economic landscape, but it's going to be a challenge. So one of the other issues you asked, Jaime, was about wages, and that's a big part of it. Wages have remained very strong. We're seeing the growth this year is 4.4% on an annual basis. So still well above, what we normally see. Depending on what inflation you measure, you look at, it could be actually just kind of keeping up with inflation or maybe even a little bit below it. But there has been strong demand. There's still 10 million job openings out there. So we're not quite as many as we were, a few months ago. There's not quite as many openings. It's trended lower, but there's still 10 million job openings. So with that many job openings, it's going to continue to have an impact on wage inflation. People are going to continue to get paid. They can command higher wages because there's a shortage of employees, and we see that everywhere we go. Yeah. If you fly, I was at a meeting recently flying at the airport. My plane was delayed over 3 hours because they had a shortage of crew. They were waiting for crew to come in to fly us out. So the airlines are experiencing shortages. Most restaurants are experiencing shortages. Most retail establishments are experiencing shortages of labor. It's kind of an across the board thing. If you look at almost any industry, they're experiencing a shortage of people. Some restaurants are having to shut down, close on certain days of the week, shut down early. We have a place up the street. They closed the restaurant for a week so their employees could take a vacation because they don't have the staff to keep the restaurant open for the week while people can take off. They need everybody there. So that's a major issue. As that continues, it's going to continue to have an impact on wage pressures. And the big issue with wages is the way the Fed views wages, and I guess the way that we should view it is, as you have a tighter labor market, it leads to higher wages, and that's what we're experiencing still. And then that prolongs inflation, right? As people have more spending power, they can afford to go out and buy these things. Tim talked about these higher loan rates. Rates are higher. Auto loan rates are higher than we've seen in quite some time. I think the average might be close to 9% now, the average loan rate and these are for people that have really good credit. But auto loan rates are higher. But how people make it happen is by higher wages, right? And as the labor market is tight like it is, they'll be able to demand or continue to get higher wages just because they're in such demand. So for the first time in a number of years, right, employees have a little bit of power over the employers that they haven't really experienced. If you remember back in the early days of the Trump administration, the fight for $15 an hour minimum wage and these type of things. Well, guess what? It's not a federal law, but it's certainly pretty much ingrained everywhere. Most jobs that are on, especially full-time jobs, they're paying $15, $20. A lot of credit unions have a minimum salaries of these $18 to $20 ranges for new tellers and things like that. So wage inflation is still a big concern of the Fed and worth keeping an eye on to see how it trends from here.
Yeah. I mean, we keep hearing it from credit unions, retaining staff has become challenging because of the wage pressure. So
yeah, it's a big issue that really all employers are facing right now, is being able to get that staffing level where they need it to be and being able to afford the employees that they need. So
yeah. So Tim, aside from inflation and labor markets, what are some of the other indicators we should be looking at going into next week?
I think I'm going to go back to what I said before. I think one is listen to the Fed, right? There's a lot of Fed speakers all the time. And if you want to know what the Fed's thinking, no better place to go than those that are in the know and the Fed presidents, and hear what they're talking about, hear what their views are. And that gives us a good look, right? So, we said we know we have a bit of a divided Fed. I mean, over the past year, the thought was, hey, everybody's on board to increase rates, right? Well, we're getting to that level now where we're kind of tweaking it, and people are on either side of the camp. We've got folks like San Francisco Fed President Daly, Cleveland's Semester, Dallas's Logan, New York's Williams that are all in the camp of, hey, we need to still raise rates, and they're to varying degrees, right? But they're still in a camp of we need to do more. And you've got folks like Atlanta's Bostic, Richmond's Barkin, and Chicago's Goolsby that think, hey, I know, reading some of President Bostic's comments said, hey, unless there's something that changes to the plan and the outlook and the way we think things will go, he thinks we should be pretty much done. The other two are kind of like, well, we got to let the fog clear on this a little bit and get some more data before we decide exactly what we should do. So we know the last set of Fed minutes showed that some, wanted to hike in June. So you've got two sides of the camp, and there'll certainly be discussions there as far as, which wins out. We're going into that blackout period, that period of time where the Fed presidents, will not speak. That'll start this Saturday, the 15th. So, you can take a look at what's already been said, but we won't have a whole lot of that, coming out from here on out. On top of that, more specific to stats, certainly have some data between now and the meeting. One of the bigger ones, retail sales. We know the consumer is certainly the majority of our economy. So how resilient is the consumer? That'll give us another look into that before we get to the meeting. Jobless claims, another piece of the employment picture that's so important for all the reasons that Scott just talked about. We'll get existing home sales again. We talked about the impact of housing on inflation. We'll see how that market's looking. And then consumer confidence. So, how are we as consumers feeling out there about the prospects for the economy, what's happening moving forward? All those will be big numbers. I don't think there's anything there that'll really change minds from the way the Fed and the individual Fed presidents feel. I think, something pretty drastic would have to happen for them to kind of go in feeling based on any of those numbers different than the way they do today. Like I said, it's more about trends than it is about any one number. But that'll certainly, some of those will still help to inform them as they go forward. But I think those things, take a look at. But I'm still in a 25 camp for July. So,
all right, Scott. One more question for you. We're roughly at mid-July. How are credit unions doing so far with liquidity during these summer months?
Yeah, so liquidity is still an issue for many credit unions. Tim has and have nots. We see a good split. There are some that still have a decent amount of liquidity, still able to generate loans as requested by their members. But the trend has gotten a little bit better, if that makes any sense, as far as liquidity or credit unions. We were in the March and April timeframe. We were well below trend for liquidity, and this is excluding the pandemic years. We were well below trend. As we've gone into the summer, and here we are in mid-July, those numbers have gotten closer to normal, what we normally see at these times of year. So that's a little bit reassuring from where I sit for credit unions, thinking, okay, liquidity is certainly still an issue. It's still tight, and that's 100%. We would expect that given the circumstances, right? That's the Fed's what they're doing. They're pulling liquidity out of the system. They're trying to tighten things up, and they certainly have been doing that to the degree of 500 basis points of rate increases so far. So that's still an issue for many, but it has improved slightly. So we're still having a lot of conversations, and I know Tim and his group have had a lot of conversations about line of credits. About increasing line of credits. Examiners are coming in, and that's one of the key issues right now is liquidity. And they're asking, how are you prepared for liquidity? What do you have in place? Is your line of credit at your corporate sufficient enough to meet demand? So we've had a lot of requests for increases to lines of credits with Vizo Financial. So Tim's group has been busy with that. We've had people using their line of credits, some for longer term funding, some for just shorter term overnight. Told them the next round of payrolls comes in and they can kind of meet the needs again for a little while. We've had quite a few conversations around issuing jumbo CDs through the Simply CD program. So we've had a few credit unions in our footprint who have been issuers of Simply CD. And a lot of times they're coming in and issuing to match off to when they have something maturing, some investments maturing. So Tim talked about this, right? A lot of credit unions, we were so low for so long with rates, and the Fed was indicating that we were going to continue to be low for long, and that financial institutions should invest this money in bonds in the bond market. So that's what they did. Credit unions and other financial institutions invested this money as the Fed wanted them to do. The problem is a lot of that money now, as Tim talked about, is underwater, right? You could sell it today, but you're going to be taking a large loss. But what we are seeing is starting maybe, some point next year, middle of next year, or maybe a little bit later into the following year, 2024 into 2025, these funds are going to start maturing off for a lot of credit unions. So a lot of them are trying to match off their liquidity, whether it's issuing jumbo CDs or borrowing bank term borrowing or from the Federal Home Loan Bank. They're kind of matching it off so it comes, that lending rolls off, or that financing, once they have these maturities coming due, which is a good thing, right? Don't lock it up for any longer than you need to. Probably sometime next year. We wouldn't anticipate it's going to be a whole lot higher rate wise, although it could be higher. The one thing that we have seen on Simply CD and with our loans too, and lending in general, is the rates have been increasing. So as an example, if you're going to issue jumbo CDs today, you're not going to be issuing anything for under 525 or 550, depending on the term, and in some terms closer to 6%, especially the shorter stuff. If you just need 6 months worth of funding, it gets a little more expensive, and it's just the shape of the yield curve. But anyway, liquidity still continues to be a concern for many credit unions. We have about another month or month and a half of these summer days to get through. But what I find interesting is, all the vacations and beach trips and everything that people spend. I've read a couple reports recently that, like Disney World, which is always packed, right? Especially during the summer months, as people are on vacation. They've increased prices, I guess, a little more than consumers are willing to pay at this time. So some places are actually a little bit slower than expected, but a lot of that is people are just taking that money, they're still spending it, but maybe not as much as a trip to Disney might cost. Maybe they're doing a beach trip or something a little more affordable. So we'll have to just see what the next month and a half brings us. But so far, the summer has ended up being better than we anticipated, based on what we were seeing earlier in the year when it looked we were well below trend. We're certainly getting closer to, we're almost on top of the annual trend lines here for the summer.
Okay, thank you. So Tim, any final thoughts?
Yeah, so I think I would just echo some of what Scott just talked about. I mean, I think two things. Number one is pricing. Make sure you're regularly looking at pricing, not only the loans but the deposits that you have, not only for the profitability of the credit union, but to make sure that you're not causing yourself liquidity problems because you're underpriced on either side. So that's one thing to pay attention to. And I think Scott talked about the liquidity issues out there. We've talked about that during this whole podcast, but for the most part, it doesn't cost anything to look at liquidity options and have them at the ready. It may take a little bit of time signing a few contracts, what have you, but most of the liquidity options that we provide anyway, doesn't cost you anything to have them in your toolkit. And even if you don't think you're going to need them, it's better to have them in a toolkit in case you do, rather than get to a point where you need them and then have to scramble to try and get something set up. Doesn't cost anything to set them up now. Make sure you have all the tools that you can have that make sense to fight against liquidity, because liquidity problems hurt the most. There's no doubt about it. So just continue to prepare.
All right, Scott, final thoughts for our listeners?
Yeah, I think the big one is one that Tim mentioned earlier, is listen to the Fed as far as the direction of rates go. They're not hiding anything from us. They're trying to be completely transparent. Chairman Powell has a press conference after every single meeting that they have, and that's done on purpose, right? They want to inform us and keep us out there, with as much knowledge as possible. So keep an eye on what the Fed's saying. Listen to the Fed members when they're speaking. Tim talked about there's a definite split at the Fed right now. of those who want to continue with rate hikes and those who think it's time to pause rather than just skip, right? Maybe pause for a while. So keep an eye on what they have to say. I think it's also important to look at the data as the Fed is, obviously pay attention to inflation and those type of things, but also pay attention to the labor market and see what's going on there. Pay attention to the ISM indexes to see what's going on there. But certainly do that, and also to track your liquidity internally. We have a number of credit unions who are doing this, and just kind of see what the outflows look like so you're on top of it. You can take steps before they get, you have to take drastic steps. You can take smaller steps, and maybe that means having a loan, a CD special for 12 months or 13 months or whatever it may be. But if you're tracking your internal liquidity, you can kind of help prepare a little bit ahead of that. And the one thing I wanted to just mention too is, there's a lot of unknown out there. We've talked about that during this podcast, Tim and I both. There's still a lot of uncertainty, a lot of unknowns. And one of the big ones I think that's coming up is student loan repayments are going to be starting back up in September again. So, I think the average student loan payment is $200 to $300 a month. So it's not a huge sum of money per person, but certainly it can have an impact on consumer spending if they're having to set aside $200 to $300 a month on a student loan payment. That's been paused for the last 3 years now or so. It's been quite a while. So we'll have to see how that has an impact on the economy. And it could be a positive impact from the Fed's perspective. Maybe it's enough to kind of slow consumer spending to a point where they're happier that inflation might, start or continue to coming down and be more contained, closer to that 2%. So listen to the Fed and listen to the markets.
Well, as always, thank you both for joining me today. I appreciate you taking the time to share your insights with our listeners. In today's episode, it's brought to you by Vizo Financial's Financial Conference. Vizo Financial would like to formally invite you to save the date for our 2023 Financial Conference. We're bringing you the finest financial education on September 13th through the 15th at the Omni Grove Park Inn, an exquisite hotel nestled in the mountains of Asheville, North Carolina. We have gathered expert speakers to present on topics like investments, interest rate strategies, as well as provide you with updates on the economy, CECL, and NAFQ regulations. We'll also be gathering together for delicious meals, networking, and just time to catch up with one another. And did we also mention luxurious spa and golf activities? We include that every year with our financial conference. And so registration is open, so please feel free to visit Vizo Financial's website at www.vfccu.org to look for more information on the conference, but hopefully to register. As always, thank you so much for listening. Make it a great day.